Thank you so much for joining us for this episode of Leading Change. My name is Emma, and I've got Christina with me today, and we're going to be talking through a little bit of the idea of the protection gap and maybe some ways that we have around it. But before I get to the questions that I've got for you, Christina, can you give everybody an introduction?
Yes, thank you. No, so nice to be here, Emma. Thank you so much for the kind invitation to join your show. So I'm Christina Lucas. I think probably like many of the people, who are listening to this podcast, I kind of fell into a career in insurance. I was looking for a career change, and I was looking for a career change in the area that provided kind of technical challenges, growth opportunities, the opportunity to really show passion and compassion. And I also wanted to kind of see the world in the process. And insurance really met the profile for that. So I started my first half career outside of insurance and management consulting. Then I moved over to insurance, and especially on the claim side of the house, I really found all those different elements. And when I joined AIG, it was really the opportunity to work in Latin America. I lived in Tokyo for several years. I lived in Europe for several years, and of course here in the US. So it was really a chance to see the world, have great adventures, and solve some of the world's biggest technical challenges. And I think that's a great career choice, like I said, for many of us.
So I gave the teaser that we were going to talk a little bit about the idea of the protection gap. So I guess maybe to get us started, one, for anybody that might not be familiar with that term, can you talk a little bit about that and then maybe look towards the idea of how we can start to use all of the data that we have available to us to really start to close that protection gap?
Mm-hmm. Yep. No, that's a really good question. And so I think to start, the general definition of the protection gap is a difference between insured and uninsured losses. So that's kind of a broad scope. So if you think about it from an insurance perspective or an economic perspective, it's really a difference between the insurance that you have in place and the amount of insurance that should be in place. So it's that gap of what you have covered and then what's not covered. And it's also from a societal perspective, the protection gap is also a measure of how resilient societies are. If there's a huge gap between the insurance that's in place in a society or in a community and what should be insured, when a disaster occurs, and especially a large-scale disaster, it's going to take longer for that community to bounce back. So it's really important for us as businesses, individuals, communities, countries even, to address that protection gap. So I think, the other question is what types of protection gaps exist and why? So kind of the most basic is kind of just uninsured risk. And traditionally, uninsured risks were risks that we didn't have data to measure, right? So didn't really understand how to quantify what the risk was. So of course, you can't kind of price that risk and place that risk in the market. But it's kind of interesting, and I think Aon did a study on this recently. More and more of the risks that were traditionally considered uninsurable risks are now kind of everyday risks that we need to insure. So if you think about reputational risk, if you think about political risk, even pandemic risk, these are all risks that traditionally the insurance markets weren't able to kind of price. They traditionally price kind of the property and pure casualty risk. But now, the insurance companies are being asked to price those risks, right? And to provide products and services that support those risks. The second, group that is experiencing kind of the protection gap are the underinsured. And there's probably two drivers for why an individual or business is underinsured. So one is most people don't really understand the true replacement cost of their asset that they're trying to insure. And my background is P&C on the property and casualty side, but I'll use kind of a basic example that all of us have, health insurance, right? Every year I really struggle with what, the coverages I should have, how much would I need? Am I going to have an accident? If I do, what do I need to cover that accident? Or if I'm not working? And so if you think about, you struggle with that on a personal level for your health insurance every year, imagine for complex assets, people trying to understand the true replacement cost of that. And then the second driver for underinsured actually happens when a disaster occurs. It might cost $100 to replace asset X in normal times, But in a cat situation, the labor costs go up and the materials costs might go up because of a shortage of supply. So that $100 in kind of normal times could be $125 in a cat. So then you've got the gap that comes from there. And then there's other kind of protection gap challenges that come from actually the language in the policy. You might have an exclusion. Oftentimes if you look at kind of the basic homeowner policy excludes certain perils like wind or flood. And so from a homeowner's policy, you might have a basic homeowner's policy, but you don't have the flood or the wind coverage. And that could be where you actually have your losses occur. The other area where protection gap comes is with coverage limits. You might have a very, a max allowable amount, $100,000 for your home, but your home is actually worth $200,000. Or you might have high deductibles, so you need to pay out $10,000 first. You might not have that cash to be able to do so. And then kind of more minor areas that cause protection gap is that you have the coverage, however, you have a challenge with your claims process. You're not able to get the appropriate documentation to prove that you own that asset or the true value of that asset or the condition of that asset. And then there's also, sometimes regulatory friction. Regulators are trying to grapple with how to address the protection gap. They put regulations in place to try to protect consumers, but it really makes it untenable for insurance companies to be able to, provide products to support that. So those are really some of the causes, right, of the protection gap. And you might wonder, is it something that's just in emerging markets or something that we have here in the US? And I did a bit of research, and Swiss Re actually did a study, I think about 2 years ago. And in the US alone, we have about a 42% protection gap for property related to nat cat events. So if you think about the US, where we have a pretty sophisticated insurance market, we do have the protection gap as a challenge here in our country. And if you look at other geographies like Latin America, that number goes up to 80% for the protection gap. So from a business perspective, that really represents kind of a mismatch in economic opportunity as well, right? Insurers could be insuring these properties. They could be really earning premiums, right, over these properties. And those property owners or those asset owners could be paying a premium to protect their assets so that they can be more productive in society. And really data, kind of going back to original question, data is really the key to be able to understand that risk better. So the insurance companies can create products to support those risks, and that individuals or businesses are able to purchase those products, right? Because they understand their risk as well and able to purchase the right set of products at the right price point to support them.
So thank you for going through. I think you did a really nice job of outlining what the protection gap is. And I think that there's, some people that maybe recognize what it is at a surface level, but even going into the pieces of like that difference between $100 in a normal day and $125 during a cat, I think is a really great way to put that into perspective. So when we start to look at leveraging this data, how do we start to really pull together like a win-win, maybe win situation when we're looking at both our policyholders, the communities that we live in, but then also carriers to really start to kind of pull together some of the compassion and those components that you talked about so nicely within our industry?
Yeah, that's a really good question, Emma. So I think there are really, two opportunities that we could pursue as an industry, right? So it's how do we create, insurance value for both the consumers and the carriers, and the consumer could be individuals with personal lines or on the commercial side with businesses. And then also, how do we really lessen the impact of a loss to a policyholder? Insurance companies have a great opportunity to not just insure the loss that occurs, but to also offer best practices, loss mitigation practices to help really lessen the amount or the impact to the policyholder of that loss, so that, going back to the resiliency discussion, they can kind of get indemnified and kind of get back to their normal operating, cadence much faster. So if you kind of look at it from a data perspective, that mismatch of data around kind of property attributes and the ownership behaviors really creates this larger protection gap. So I'll use kind of two basic examples. Homeowners data. Homes were built, between, the last couple hundred years, right? So you could have one neighborhood that has a house that's 100 years old, another one that has a house that's 10 years old, as an example. There could have been all these different renovations that were done to that house over time. And so there's not really a public set of data that has all of the house attributes, right? So I live in Miami-Dade, and we recently bought a property and a condo that's on the beach. And I called around to a couple of agents, and they're like, we don't write any policies, any homeowners policies for anybody in Miami-Dade. I talked to another agent who said, we don't write any policies for anyone that lives within 2 miles of the beach. So regardless of the attributes of the property, and their property has, hurricane windows, right? Or even for the attritional losses, flood sensors or water sensors, they're not even looking at those properties. So it's a missed opportunity for the insurance companies to insure those losses, right? Especially if it's considered kind of a good asset, with the appropriate loss mitigation tactics put in place to protect that asset, right? And that's because there's a lack of data really at that property level, in many instances, for them to really understand the risk and to price that risk. On the extreme side, on kind of the flip side, if you look at auto, you have a lot of data for auto because we know all of the attributes of every automobile that's on the market, that's driving around the street, right? So there's a much smaller kind of decrease in that protection gap on the auto insurance side because we know the cars have a ton of data with sensors and everything about how people are driving, what happened at the scene, how much it costs to repair this bumper. And so it's very clear kind of what, the repair or replacement costs will be for that asset. So, really that data is creating opportunities, or having more data is creating more opportunities to create insurance products that will help to service that gap. So that's from the traditional insurance side, where traditional insurance is, I have an auto policy that's going to cover the repair costs for my car that was damaged in an accident. I go to an auto body shop. The auto body shop says it costs $5,000. My insurance company pays the auto body shop $5,000. What's really cool now is, and it's actually been around for quite a long time, is parametric insurance, right? So parametric insurance also creates an opportunity to indemnify an individual or a business, but it's based on a parametric event. So a parametric event is basically, really, parametric insurance is that a fixed amount, is paid out when a triggering event occurs. And you can be really creative with what that triggering event is and what the payment is, right? And the triggering event can happen at the time of a loss, which is where traditional insurance occurs, but it can also happen before that total loss happens, which is also really cool because you can help to mitigate the impact of a loss, really lessen the impact of a loss. So for example, with parametric insurance, as an example, if 12 inches of rain falls in my neighborhood within a 2-hour period, I might receive a $5,000 flood payment. And so that's really helping me to mitigate the impact of all of that torrential rain without me having to file a claim. And that's really, really game changing for the industry because it simplifies the claim handling process. I didn't have to collect any papers and take pictures. I didn't have to wait for a claim adjuster to come to my home weeks later, after the event occurred in order for me to file that loss. And it's also speeding up the time that I can get back to normal because it rained 12 inches. It's highly likely that I've got flood damage in my basement, and I can call somebody, a water mitigation company, to come in and remediate that loss immediately versus waiting for my insurance company to come, which could be days or weeks later, and which also worsens the impact of that loss, right? So parametric insurance is a really cool tool that you really see started with the reinsurers like Swiss Re, Munich Re, several years ago. Now you see the brokers, Marsh and Aon being really innovative in their risk solutions and developing parametric policies, kind of others in the ecosystem doing that. And, if you kind of think about some of the cool things, not just that are happening in the US, from a parametric insurance, but the ability to service emerging markets, to be able to say, if there's a drought in this area that would severely impact a population or a flood, there's different distribution channels, where people could access that parametric policy from their cell phone and then get paid back immediately when that parametric event occurs. So I'm really excited about, the opportunities that are happening in the parametric side as an additional way to help create a win-win solution, both for the consumers, and for the carriers in our industry.
Well, and I think you gave some really good examples of where both like parametric coverage could be used, but I'm wondering if you could help paint a picture for us of like what the ideal would look like of what some of these win-win situations could be to kind of end our time together.
Yeah, so another example of that could be, I'll use a drought situation. A traditional insurance product would say, for a farmer, I'll say in Nebraska, once your wheat crop fails or your corn crop fails, you can file an insurance claim and be paid out for that claim, right? So basically the farmer's gone through the whole season hoping for rain. The rain didn't come. And at the end of that, the insurance company will pay him for a loss, but he lost the whole year, right? He lost the whole year of his productivity on his farm. And then from a market perspective, we didn't get that corn or that wheat in the market. So of course, then our grain prices go up as a society, right? With a parametric cover, it could be something like, if there are 40 days of no rain consecutively, then the farmer will get paid out, X amount of money, because the direction that it's going is that it's going to be a total loss. So then that farmer can take some mitigating actions because they received a payment, 40 days in, because of the lack of rain. And they could use that payment to bring in water from an external source, put an irrigation system, something to help remediate or lessen really the impact of that loss to the crop. So instead of waiting until there's a complete crop failure before the insurance claim is filed, they can receive something as an intermediary step to help lessen the impact of it. So I'm really excited about that possibility of how do we not just indemnify once a loss has occurred, but help to kind of lessen, right, or remediate a loss before it gets to that severity.
Well, thank you so much for joining me for the conversation, Christina. And for anybody that's not already, make sure you make your way over to her LinkedIn, get connected with her there, and certainly reach out to either one of us if you've got any questions. But thank you again for your time, and thank you everybody for joining us, and have a wonderful day. Thank you so much for joining me for this episode of Leading Change. If you liked what you saw, be sure to subscribe and come back weekly for more expert interviews on digital transformation, change management, and emerging technologies.